In today's India, trading can be a real song and dance.
Over the last few years, we have seen a significant rise in retail participation in India's booming equity markets.
Up until last year, growth in India overtook major markets across the world. Here's the S&P 500, and here's India's MSCI index outpacing it. But recently, the market's taken a turn.
India's stock market is headed for the worst month in a couple of years.
Well, stocks in India have wiped out, though, over $1 trillion from their market value.
Despite the volatility, retail investors in the world's most populous country are still pouring money into the market.
I'm not worried at all about India's current market downturn. In fact, I see it as a very, very good opportunity.
This has regulators on edge, especially as unscrupulous opportunists exploit those new to trading. So, what's led to this boom in everyday investors in India, and why is it making regulators worried? First, let's take a look at what's behind the surge of retail investors jumping into India's capital markets.
If you look at the number of trading accounts, it has grown fourfold in the last 5 years and is now nearing 200 million accounts.
And it's not just about the number of sign-ups. Individual investors, together with mutual funds, own roughly 18% of India's equity market and surpass the share of foreign investors for the first time since 2006.
If you look at mutual funds, the equity assets under management that they've been holding has also grown more than 4 times in the last 5 years.
India's always had strong retail participation in its equity markets. If you look back 25 years ago, retail investors were the largest proportion of this market, except at that time, it was very, very rich Indians and large broker-dealers. What you're seeing play out today is a more broad-based secular trend that in many ways defines the financialization of savings in India.
The country's expanding middle class traditionally saved in real estate, precious metals, or cash. But now,
Indian households, including young Indians, which is now the largest demography in the country, are preferring to put their earnings in better yielding instruments like equities. They now know that they want to invest towards their retirement, and so therefore their investment horizon is more long-term.
Experts liken it to the US in the 80s and 90s after the introduction of the 401k retirement plan. A nascent desktop internet helped spread knowledge about investments to an eager American population. The mobile equivalent is alive in India today.
The pace at which many countries access technology was a slow and gradual growth, from computers to then laptops to mobile phones. But in India, the vast majority got access to the internet directly through smartphones. Those have enabled them to go into social media, learn about investing, get registered with discount brokers, and start investing as soon as possible. Another important change was the introduction of eKYC.
That stands for Electronic Know Your Customer, and it's the next big catalyst behind India's retail investor boom. With eKYC, instead of having to physically go to a brokerage armed with papers and ID cards, rookies could do it anywhere. Their IDs are already linked to a bank account and show their date of birth and home address. New investors just need to upload it, snap a selfie, and sign on the dotted line. Once the account is approved, trades can be made for as little as 100 rupees, or just over $1. Apps like Zerodha contributed to that surge in sign-ups to trading accounts we saw earlier, one of which caught the attention of 23-year-old Joseph Shaz.
As a young boy, I always wanted to find ways where I could make much higher returns for the money that I had. So as soon as I turned 18, and I started investing with Zerodha, using the pocket money that I got in college. My stock market investments would be around 90% of my total assets. I choose companies which I personally know of, or at least I understand the business of. 60-70% of our investments are in the financial sector. My investment strategy on how I place my investments is I go in with the potential that I'm going to remove this fund maybe after 20 years.
While investors like Joseph are betting on the market's long-term potential, others may be distracted by what's happening right now.
Does the bull run in Indian stocks have further to run, or are we looking at a pullback at this point?
We saw earlier that Indian stocks overtook global peers for years since the start of the COVID pandemic. But look what happens when we extend that timeline into this year.
We've seen a significant fall in India's stock market indices, the benchmark indices, as well as in select stock prices.
The benchmark Nifty index had fallen to about 16% from the top that we saw on September.
So what's caused that? Well, firstly, foreign investors.
They've sold more than $15 billion worth of stocks. For a variety of reasons, China looked more interesting last year because Chinese markets and equities had become much cheaper, on account of their economic downturn.
In the meantime, India's growth is also slowing, raising concerns that the consumption boom, which contributed to India's stock market surge, is coming to an end. Another factor was that Indian companies began to look overvalued. Last year, total market value of the stock market in India reached a record high of 140% of its GDP, much more than the 12-year average of 86%.
There are many small and mid-cap companies who are coming to market to do IPOs, but not with maybe the best of fundamentals underlying their businesses.
A case that grabbed a lot of attention was the IPO of Resourceful Automobiles Limited. The company operated just 2 dealerships and had an employee count of less than 10. And this issue was subscribed more than 400 times in India.
That means demand for new shares was 400 times higher than that which was actually available. It was a sign of overheating or inflation of the market, which isn't sustainable. To seasoned market players, this might all look like your classic boom cycle, but India's boom wasn't driven primarily by seasoned pros. With this boom market, there was also a rise in scams targeting fresh investors.
There have been several high-profile cases where people have been lured into the market, promised really high returns, and they ended up giving away their money to brokerages that never existed in the first place. It is not just people who are uneducated that are falling into these scams. It is coming from cities, villages, and there are many people who have taken loans to invest.
There was also a surge in influencers who encourage risky trading, often as all or nothing bets on future share prices. Last year, SEBI, India's security market regulator, published an eye-opening report that suggested 93% of such investors incurred losses. It also imposed rules to limit speculative trading. And just look at the effect it had. Here's the number of options contracts being traded over the last 5 years. Then SEBI's report landed and options trading plunged. Volatility tests investors, and a world of strained alliances and economic uncertainty will challenge India's investors keenly.
On the one hand, we have impending tariffs that are likely to be levied by President Trump. And then on the other hand, we have China that continues to export, and many Indian businessmen are worried about dumping by China in the Indian economy.
India's economic growth is set to hit a 4-year low this year. The rupee slid to record lows against the dollar and is likely to remain under pressure.
You've got earnings growth for the current financial year, which is kind of very, muted, like low single digits. Until you see that recovery to justify the valuations, there isn't a huge catalyst at the moment for India.
While investors like Joseph hold on to India's growth narrative, regulators are finding it increasingly difficult to shield markets from rising economic uncertainty.